Welcome to session 11, corporate valuation or business valuation. As we have learned, valuation is a central theme in finance. We have discussed valuation of stocks, we have discussed valuation of bonds, we have discussed valuation of projects. Now we turn to valuation of companies or valuation of businesses. The outline of the session is given here. 1. Approaches to valuation. 2. Adjusted book value approach. 3. Relative valuation approach. 4. DCF approach. 5. Strategic approach. 6. Reflections on valuation. Valuation has to be done in a number of contexts. When a nascent company raises capital from a venture capitalist, valuation of the company has to be done. When a company makes an initial public offer, its valuation has to be done. For example, Alibaba made its IPO in 2014 on Nasdaq and its valuation had to be done. Valuation is a very critical element in any merger exercise. Ranbaxy was merged with Sun Pharma. Shareholders of Ranbaxy were given shares of Sun Pharma. So a relative valuation of the two companies was done to determine the exchange ratio. Valuation is critical in a takeover. When Hindalco acquired 54% stake in Hindal from Alcan, Canada, a price had to be fixed for the controlling block. Similarly, when Tata Steel acquired Chorus in its entirety, a valuation of Chorus had to be done. Purchase of plant or division. SRF acquired the nylon tire cord division of SEAT. Evaluation of that division or business had to be done. Valuation is a very sensitive element in a PSU disinvestment. When Government of India sold its stake in IPCL to Reliance Industries Limited, a valuation exercise had to be done. Valuation is done whenever a company is doing a buyback. Sometime back, Piramal Enterprises did a buyback of shares. As far as investors are concerned, they have to value all the time to determine whether they have to invest, hold, or sell securities in which they have some interest. Given the complexity of valuation, there are several approaches to valuation: book value approach, discounted cash flow approach, relative valuation approach, option valuation approach, and strategic approach. Our thrust will be mostly on discounted cash flow approach and relative valuation approach. Of course, we will discuss other approaches as well. Another popular classification of valuation approaches is shown here: income approach, market approach, and asset approach. Income approach has three variants: DCF or discounted cash flow approach. Here, future free cash flows are forecasted and discounted to the present point of time using the weighted average cost of capital to get the value of the firm. Dividend discount model approach. Here, future dividends are forecasted and discounted to the present point of time using the cost of equity to get the value of equity of the firm. Maintainable earnings approach. Here, maintainable earnings are estimated and capitalized at an appropriate rate to get the value of the firm. Market approach has three variants: prevailing market prices. Here, the prevailing market prices of equity and debt are regarded as good proxies of intrinsic value. They are added to get the value of the firm. Market comparable method. This method is used for valuing an unlisted company. For valuing an unlisted company, we look at similar companies in the listed space, use the valuation metrics of those companies to estimate the value of the unlisted company. Market transaction method is usually applied for valuing a business unit or division. Here we look at similar transactions and use those values to get a handle over the value of the business or division. Asset approach has three variants. Book value approach relies on book value numbers as given in the balance sheet. Replacement value approach looks at the replacement value of assets and liabilities. Realizable value approach asks a very basic question: if the assets of the firm are liquidated, what value they would realize. These are the most commonly used approaches to valuation. We'll discuss them in greater detail. Here is an interesting illustration of adjusted book value approach. On October 21, 1999, the price per share of Reliance Industries Limited was 400. At that time, Anil Ambani handled the finances of RIL, and he made a public statement saying that Reliance was undervalued in the market. According to him, the price per share of Reliance ought to have been 650. His argument ran as follows. The replacement cost of Reliance Industries Limited plant was estimated at 40,000 crore rupees. Reliance had a 50% equity in Reliance Petroleum Limited, which was valued at 15,000 crores. Reliance had substantial equity holdings in BSES and L&T, which were valued at 10,000 crores. Reliance had a 30% interest in Panna Mukti Tapti Oil Ventures, which was valued at 2,600 crores. Reliance had cash holdings of 6,000 crores. All these added to 73,600 crores. Reliance had outstanding debt of 9,000 crore rupees. Subtracting that, he arrived at a net asset value attributable to equity as 64,600 crore. The number of outstanding shares of Reliance at that time was 100 crores. Dividing 64,600 by 100 crores, he arrived at a figure of rupees 646. So he claimed that Reliance should have commanded a market price of 650 rupees per share. Book value has some appeal. It appears objective, it looks tangible, it is based on historical financial statements. Book value, however, differs from market value due to several reasons. Often we find that market to book ratio is 3, 4, 5 or even more, and the discrepancy between market value and book value stems from several factors. Inflation drives a wedge between historical book value and current market value. Technological changes also may mean a difference between the two. Modern enterprises have become highly intangible intensive, and many intangible assets such as brand equity, technological capability, managerial talent, organizational processes are not reflected on books, but they are very valued in the marketplace. The most important approach to valuation is the DCF approach or discounted cash flow approach. We have already learned about the DCF approach in the context of project valuation. The same approach can be applied for valuing companies or businesses. In the case of a project, we assume that it has a finite life and we regard it as a one-off investment. However, in the case of a company, we assume that the company has an indefinite or infinite life, and a company is a growing entity which requires continuing investment. These are two complications that we have to add in order to make the exercise more relevant for a company, and this makes it more interesting, challenging, and sometimes frustrating. Before we discuss DCF approach to company valuation, let us recapitulate how we applied the DCF approach for evaluation of an individual project. Here is an example that we had discussed earlier. In this example, we are considering a project that entails an outlay of 100 million rupees, 80 million toward fixed assets and 20 million toward net working capital. This project has an economic life of 5 years. It is expected to generate an annual revenue of 120 million for 5 years. The cost, depreciation, profit before tax, profit after tax are shown here. It is estimated that at the end of 5 years, when the project is wound up, fixed assets would realize a net salvage value of 30 million. Net working capital would realize a salvage value of 20 million. Based on this information, we derive the cash flows of the project. Profit after tax has been estimated at 14 million for year 1, 17.5 million for year 2, so on and so forth. If we look at the picture for year 1, there is a depreciation charge of 20 million. Since it is a non-cash charge, we add it back to profit after tax of 14 million to get operating cash flow. Our objective is to find out post-tax cash flows associated with the project. Similarly, for year 2, we add back the depreciation charge of 15 million to profit after tax of 17.5 million to get post-tax cash flow 32.5 million, so on and so forth. So we have an initial outlay of 100 million, operating cash flows as shown here, and a terminal cash flow on account of liquidation of assets of 50 million. When we add these three rows, we get the net cash flows of the project, and we discount net cash flows at the weighted average cost of capital to get the net present value of the project. This exercise is fairly straightforward. Now we have to add complications relating to an infinite life and periodic investment that may be required in order to support the growth envisaged for the firm. How do we tackle the problem of infinite life or indefinite life? It is almost impossible to forecast cash flows year by year for an infinite period. So, as a practical expedient, we divide future into two parts: planning period or explicit forecast period and balance period. The planning period may be a period of 5 to 10 years, and the balance period represents the balance period. It is assumed that the company would evolve rapidly in the next 5 to 10 years, which is the planning period. It may have a higher growth rate to begin with, which will moderate gradually and then settle down at a rate which is sustainable forever, so that the balance period is a period where things are relatively stable. Essentially, in the balance period, we assume that return on invested capital, weighted average cost of capital, and growth rate stabilize so that we can apply simple valuation formulae. This is an assumption that is commonly made in DCF valuation. It is assumed that the firm would reach a steady state at the end of the planning period. Without that simplification, it becomes an almost impossible exercise to value a company. The discounted cash flow approach to valuing a firm involves 4 steps. 1. Forecast cash flows for the planning period. The planning period is a period of 5, 7 or 10 years. During this period, the firm is expected to evolve rapidly. At the end of the planning period, the firm would achieve a certain stability. 2. Estimate the cost of capital, taking into account the capital structure of the firm and the cost of equity and debt. Estimate the cost of capital. 3. Determine the continuing value. At the end of the planning period, a continuing value has to be estimated. The continuing value is also called as horizon value or terminal value. We are looking at a firm for an infinite life, so we have to look at cash flows during the planning period and the continuing value at the end of the planning period. For calculate the firm value is the present value of cash flows during the planning period and the present value of the continuing value. To understand the DCF approach, let us look at a numerical example. The invested capital of a company currently is 50 million rupees. The return on invested capital is 12%. The weighted average cost of capital is 11%. The company is expected to enjoy a healthy growth rate of 20% per year for the next 3 years. Thereafter, the growth rate is likely to slow down to 12% and finally settle down at 8%. This is the growth trajectory envisaged during the planning period. At the end of 6 years, which is the planning period, the growth rate will remain at state 8% per year forever. This is what I meant by saying that we assume that the company evolves rapidly during the planning period. Thereafter, it stabilizes, and in the steady state that prevails after 6 years, Return on invested capital will continue to be 12%. Weighted average cost of capital will also continue to be 11%, and the growth rate will remain at 8% per year forever. Given these assumptions, let us look at how DCF valuation is done. The invested capital at the beginning is 50 million. Return on invested capital is 12%. So no PAT or net operating profit after tax for year 1 would be 66 million, which will come at the end of year 1. Since the company has a growth rate of 20%, which applies to revenues, investments, and no PAT, it has to make a net investment of 10 million at the end of year 1 because of an initial investment base of 50 million and a growth rate of 20%. Now, no PAT is 6 million, net investment required is 10 million, so free cash flow is a negative amount of 4 million. Free cash flow is defined as no PAT minus net investment. Free cash flow represents a net exchange of cash between the firm and the investors. At the end of year 1, investors will have to infuse on a net basis an additional amount of 4 million to sustain the growth of 20%. Investors may get dividend and interest from the company, but they will have to contribute equity and debt so that on a net basis they infuse 4 million. This happens all the time for rapidly growing companies. Investors have to contribute funds in the initial stages when the growth rate is high. What happens in year 2? The beginning invested capital is 60 million. No PAT would be 12% of 60 million. Net investment required would be 20% of 60 million. So free cash flow for year 2 is also a negative figure of 4.8 million. Come year 3, beginning invested capital is 72 million. No PAT is 12% thereof. Net investment required is 14.4 million. So free cash flow for year 3 is also negative. It is minus 5.76. Come year 4, the growth rate slows down to 12%. So no PAT of 10.37 million is enough to meet the net investment requirement. Net investment requirement would be 12% of 86.4, which is 10.37, which is just equal to no PAT. As a general rule, if growth rate is 12% and ROIC is 12%, then free cash flow is 0. In other words, if growth rate and ROIC are the same, free cash flow is 0. That is intuitively clear because if a firm has an ROIC of 12% and if it is growing at 12%, no PAT would suffice to meet its net investment requirement. This continues for another year because the growth rate is again 12%, which is equal to ROIC. Come year 6, the growth rate slows down to 8%, so net investment requirement is 8.67. No PAT is 13 million. There is a positive free cash flow of 4.33 million. In year 7 also there is a positive free cash flow of 4.69 million. Now that the growth rate has stabilized at 8%, free cash flow would grow at a rate of 8% per year forever. Given these cash flows, we can now calculate the DCF value of the firm. We first look at present value of free cash flows during the explicit forecast period or planning period, which is a period of 6 years. The cash flows are drawn from this row. The weighted average cost of capital is 11%, so present value of free cash flow during the planning period is minus 9.53. What is the present value of continuing value? Continuing value is established at the end of year 6, because if you stand at the end of year 6, you know that the next free cash flow will be 4.69, and this will continue to grow at a rate of 8% per year forever. So we apply the formula that we have learned in the context of equity valuation, where we said if dividend per share grow at a constant rate, then the present value of the dividend stream would be D1 divided by R minus G. In this case, it will be free cash flow for year 7 divided by cost of capital minus growth rate. Remember, we are estimating the continuing value as at the end of year 6. So we'll have to look at free cash flow for year 7 and divide it by weighted average cost of capital minus growth rate. This continuing value is estimated at this point of time. It has to be brought down to the present point of time, so it has to be further discounted, and this is the present value of continuing value. When you add these two numbers, you get the DCF value of the firm as 74.05 million. Let us explore the 4 steps involved in the DCF approach in some detail. Step 1, forecast performance. This is understandably the most important step. There are 3 sub-steps here. 1, select the explicit forecast period. The explicit forecast period is also called as the planning period. 2, develop a strategic perspective on the future performance of the firm. In order to derive financial forecast, we need a sound strategic perspective. 3, convert the strategic perspective into financial forecasts. The general guideline for determining the length of the explicit forecast period is, at the end of this period, the firm reaches a steady state. The steady state has the following characteristics: constant return on invested capital, constant growth rate, and a stable cost of capital. Develop a strategic perspective. The strategic perspective reflects a credible story about the company's future performance. One such story about a telecom software provider is given below for illustrative purposes. By the way, this is a story I had crafted as I was engaged in the evaluation of this company. The global telecom market is recovering. The company is well positioned in those segments of the telecom market which are growing rapidly. The company has restructured its licensing arrangements with its customers, and this is expected to augment its overall income from licensing. The combination of these factors is expected to generate a robust growth in revenues and improve the net profit margin over the next 5 years. Here is another example of a plausible story about a company's future performance. Demand is increasing rapidly because of changing demographics, yet prices will remain stable because of the competitive structure of the industry. Given the company's competitive position, it should be able to increase its market share somewhat, though profitability will remain constant. The story should be based on a thoughtful strategic analysis of the company and its industry. Extensive strategic literature will help you to develop those stories. The strategic perspective serves as a foundation for developing the financial forecast. Financial forecasting involves forecasting revenues, estimating operating costs, working capital, and fixed asset requirements, forecasting non-operating items such as investments, non-operating income, interest expense, and interest income. Forecasting is a fairly detailed exercise. In real life situations, a financial model has to be created so that forecasts can be developed under alternative scenarios. I have explained the broad approach involved in line with the thrust of this course without getting into financial modeling and detailed forecasting. To estimate cost of capital, the cost of capital, the discount rate used for converting cash flows into their present value. It represents the weighted average cost of all source of capital. It is calculated in post-tax terms. It is defined in nominal terms. It is based on market value weights. It is adjusted for risk. The formula that may be employed for estimating the weighted average cost of capital is weighted average cost of capital is equal to cost of equity multiplied by the weight assigned to equity plus cost of preference multiplied by the weight assigned to preference plus interest cost on interest bearing debt multiplied by 1 minus tax rate, the whole multiplied by the weight assigned to debt. The weights are based on market values. Estimate the continuing value. A variety of methods are available for estimating the continuing value. They may be classified into two broad categories: cash flow methods and non-cash flow methods. The important cash flow methods are growing free cash flow perpetuity method. This is the method that we had used earlier. Value driver method. Non-cash flow methods are replacement cost method, price to PBIT ratio method, price to book ratio method. Growing free cash flow perpetuity method. This is a widely used method for estimating the continuing value. Continuing value at time t is equal to free cash flow for t plus 1 divided by weighted average cost of capital minus growth rate. This is the formula we had used in our numerical illustration. This is conceptually identical to the constant growth dividend discount model, where we say PO is equal to D1 divided by R minus G. Calculate firm value or enterprise value. McKinsey defines enterprise value as value of operations, which is present value of free cash flows from operations plus value of non-operating assets such as surplus land, excess liquidity. Based on enterprise value, they derive equity value as enterprise value minus value of non-equity claims. Other consulting firms and valuation experts look at things a little differently. According to them, value of operations represents enterprise value and firm value is enterprise value plus value of non-operating assets. What McKinsey calls as enterprise value, others refer to it as firm value, and they define firm value as value of operations, which for them is enterprise value plus value of non-operating assets. This gives value of equity plus value of non-equity claims. Calculate firm value and interpret the results. Valuation is done to guide some management decision like acquiring a company, divesting a decision, or adopting a strategic initiative. Hence, the results of valuation must be analyzed from the perspective of the decision at hand. At a minimum, you should address the following questions. If the decision is positive, what can possibly go wrong to invalidate it? How likely is that to happen? If the decision is negative, what upside potential is being given up? What is the probability of the same? Now we come to what I regard as Zen of corporate finance or essence of corporate finance. The horizon value or continuing value of the firm looms large in most valuation exercises. Dropping the subscript for the sake of simplicity, we get value is equal to free cash flow divided by weighted average cost of capital minus growth rate. Free cash flow, the numerator of the right hand side of this equation, may be expressed as follows. Free cash flow is equal to NOPAT minus net investment. We can express this in this manner. NOPAT is taken outside a bracket. Inside we have 1 minus net investment divided by NOPAT. If you simplify this, you get back to NOPAT minus net investment. However, we are doing it this way to identify the key drivers of value more clearly. Now look at the expression within the brackets. Here you have a ratio, net investment divided by NOPAT. I divide the numerator as well as the denominator of this ratio by invested capital. If you divide the numerator and denominator of a ratio by the same thing, the ratio remains unaffected. Net investment by invested capital is the growth rate. NOPAT divided by invested capital is return on invested capital. NOPAT is the product of invested capital and return on invested capital. So equation 1 may be expressed in this manner. The numerator of the equation is free cash flow, and free cash flow may be defined in this manner. The denominator is weighted average cost of capital minus growth. From this equation, we find that the value of a firm depends on four factors: invested capital, return on invested capital, growth rate, and weighted average cost of capital. These are the four drivers of value. That is why I call this formula as the formula that reflects the Zen of corporate finance. In corporate finance, our focus is on invested capital, return on invested capital, growth rate, and weighted average cost of capital. All the rest is a matter of detail. Given the importance of that formula, it is worth recapitulating the key determinants of value. Value is a function of invested capital, return on invested capital, growth rate, and weighted average cost of capital. Daniel Ariely wrote a very fascinating book titled Predictably Irrational. In that book, he wrote, "Everything is relative, even when it shouldn't be. Humans rarely choose in absolute terms. We don't have an internal meter that tells us how much things are worth. Rather, we focus on the relative advantage of one thing over another and estimate value accordingly." The DCF approach is conceptually very sound. However, it is information intensive and not very intuitive. People look for something which is easier to implement and which is intuitive. So relative valuation has a lot of appeal. In relative valuation, we value a target company relative to similar companies that may be listed on the public market. The steps in relative valuation are: analyze the subject or target company, select comparable companies, choose the valuation multiple or multiples, calculate the valuation multiples for the comparable companies, value the subject company. A very important requirement of relative valuation is to find companies which are comparable to the target company. For purpose of determining comparability, we look at factors like size, business portfolio, geographic diversification, operating leverage, differences in margins and market shares, differences in efficiency and economies of scale, capital structure and accounting policies. It must be emphasized that it is almost impossible in real life situations to find companies which are exactly comparable to the target company. We have to make do with companies which are as close to the target company as possible and somehow carry on with the valuation exercise. This seems to be inescapable in relative valuation. The multiples that are often used in relative valuation are price to sales, price to EBITDA, price to EBIT, price to earnings, price to cash flow, and price to book value. To understand relative valuation, we look at an illustration. The following financial information is available for company D, an unlisted pharmaceutical company which is being valued. The financial numbers of company D are as follows: EBITDA 400 million, book value of assets 1000 million, sales 2500 million. Normally we look at some measure of revenue, some measure of assets, and some measure of earnings. These are three principal factors which influence valuation. Based on an evaluation of a number of listed pharmaceutical companies, three companies A, B, and C have been found to be comparable to company D. The financial information for these companies is given below. Sales, EBITDA, book value, enterprise value for A, B, and C are given in this table. Enterprise value here is market value of equity plus market value of debt. Three valuation multiples have been considered: enterprise value to EBITDA, enterprise value to book value, enterprise value to sales. These multiples for companies A, B, and C are shown here. These calculations have been made from the data previously looked at. The enterprise value to EBITDA multiple for A is 7.1, for B it is 9.7, for C it is 8.8. An arithmetic average of these three numbers is 8.5. Enterprise value to book value for A is 2.5, for B it is 3.5, for C it is 3. An average of the three is 3. Enterprise value to sales for A is 1.25, for B it is 1.75, for C it is 1.31. The average of these three is 1.44. Applying the average multiples to the financial numbers of firm D gives the following enterprise value estimate. EBITDA basis, average enterprise value to EBITDA is 8.5. EBITDA of D is 400 million. So enterprise value of D using this basis is 8.5 times 400, 3,400 million. Book value basis, average enterprise value to book value is 3. Book value of D is 1,000 million. So enterprise value of D using this basis is 3,000 million. Sales basis, average enterprise value to sales is 1.44. Sales of D is 2,500. So enterprise value of D is 1.44 times 2,500. It is 3,600. A simple arithmetic average of these three estimates, that is 3,400 million, 3,000 million, and 3,600 million, is taken, we get a number of 3,333 million as the value of firm D based on these three multiples. There are alternative descriptions of relative valuation. It is also referred to as market multiple valuation, comparable company valuation, guideline company valuation, direct comparison valuation. Pros and cons of market approach or relative valuation approach. Market approach is immensely popular because it is simple and easy to relate to. That is why in equity research reports and valuation reports we find multiples being used extensively. Perhaps relative valuation is more popular than DCF valuation in practice. Despite its appeal and popularity, relative valuation suffers from several limitations. One, multiples are amenable to misuse. We have a wide range of multiples: price to EBIT, price to book value, price to sales, price to profit after tax, price to EBITDA, price to free cash flow. The analyst may use a multiple or a set of multiples that serve the purpose of the analyst. Two, it is very difficult to find comparable companies, so there is an inescapable element of subjectivity in choosing companies which are fairly comparable to the target company, and the choice of such companies disguises the subjective bias of the analyst. In DCF analysis, assumptions have to be made more explicit. In relative valuation, subjective biases are disguised. 3. Relative valuation builds in errors of market valuation. Markets can be irrationally exuberant or markets can be irrationally despondent. When relative valuation is used when markets are irrationally exuberant, inflated values are obtained. When relative valuation is used when markets are irrationally despondent, deflated values are obtained. In DCF valuation, in theory, we estimate the value of a firm on the basis of firm-specific growth rate and cash flow. So, in theory, DCF valuation is immune to the kind of irrationality that may be prevailing in the market at that point of time. However, as we have learned, minor tweaking of assumptions underlying the DCF model can result in a wide range of valuation. In DCF valuation, we assume that at the end of the planning period, the firm would reach a steady state where all the financial parameters are stable. Many analysts are not comfortable with this assumption because they believe that the firm is likely to evolve further even after that. So they use free cash flow during the planning period and apply a certain multiple to estimate the continuing value. This is a hybrid approach which is quite popular in practice. The hybrid method may be illustrated with a case study. Here is a case study of BHEL. I was involved in a valuation exercise of BHEL in early 1992. I was asked by BHEL to do a valuation of the company as on 31st March 1992, which was the lien date for valuation. BHEL asked me to do that exercise because in the wake of liberalization, BHEL felt that it could get a strategic investor and it needed a handle over its value. I was fortunate to work with a team of executives at BHEL in this valuation exercise. I was pleasantly surprised that they had a very detailed 5-year planning forecast and a 5-year plan. Based on the 5-year planning document, the numbers here have been obtained. The projected turnover was 3350 crore for 92-93, 3700 crore for 93-94, so on and so forth. These numbers were fairly credible because BHEL had a strong order book position. The growth rates are shown here. Earnings before depreciation, interest and taxes was assumed to be 12%. This was a norm in BHEL. Depreciation was assumed to be close to 3.12%. This was a norm in BHEL. EBIT was estimated as 8.8%. This was a norm in BHEL. The tax rate for 92-93 was 45%. Dr. Manmohan Singh had announced that he would lower the corporate tax rate in subsequent years in 2 installments. Based on that announcement, the tax rates for subsequent years were estimated at 40%, 35% and so on respectively. So the tax liability was estimated. No PAT was found. To no PAT, we added depreciation to get gross cash flow. From gross cash flow, gross investment in fixed assets and working capital were deducted. There are 2 ways of getting free cash flow. We have learned that free cash flow is NOPAT minus net investment. It can also be defined as gross cash flow minus gross investment. Gross cash flow is NOPAT plus depreciation, and gross investment would be net investment plus depreciation. Irrespective of which calculation you use, you get the same number. So we had projections for free cash flow for 5 years. A weighted average cost of capital of 12.5% was used to convert free cash flows for 5 years into present value. So free cash flow for 5 years during the planning period had a present value of 773 crore. In order to get a handle over continuing value, we looked at alternative ways of doing it. BHEL had a very sketchy idea of what would happen beyond 5 years, since detailed plans were not available, we decided to rely on relative valuation. In relative valuation, we apply a multiple to some number such as NOPAT, earnings, free cash flow, book value, and so on. In the case of BHEL, we decided to estimate continuing value as a multiple of free cash flow in year 5. Free cash flow in year 5 was estimated 311 crore. We applied a multiple of 12, and this continuing value, which was estimated as at the end of 31st March 1997, was brought down to present value by applying a suitable discounting factor. So the total firm value was the sum of present value free cash flow during the planning period plus present value continuing value. The outstanding debt of BHEL was 775 crore. The number of outstanding shares of BHEL were 24 crore. So the value of equity was divided by number of shares to get an intrinsic value per share of rupees 86.2. I had a very interesting experience in doing this exercise. Choice of methodology. DCF approach makes sense when current earnings are not reflective of future earnings, when the company is in a high growth phase and the company is evolving rapidly, and detailed business plans and cash flow projections are available. Relative valuation makes sense when current earnings are reflective of future earnings capacity. The company expects a fairly stable growth rate, and there are several comparable companies which can be used as benchmarks. Adjusted book value makes sense in a situation where we are estimating the liquidation value or where we are trying to establish a minimum benchmark for valuation. Strategic approach to valuation. The DCF approach is widely used in valuing companies because it is conceptually sound, and consulting firms have developed practical methodologies for applying it. However, it has certain weaknesses. The DCF approach to valuation has certain limitations. 1. It mixes reliable information with unreliable information. Usually, near-term cash flow information is more reliable than information about terminal value. As we have seen, terminal value is estimated using certain simplifying assumptions. So terminal value cannot be estimated as reliably as near-term cash flow information. 2. It discards a great deal of information that is relevant for calculating the value of a company. It completely ignores the book value of assets. They provide useful information for valuing a company. Since DCF approach relies only on free cash flows and ignores book value of assets, it discards a great deal of information that is relevant for company valuation. 3. It relies on assumptions that are difficult to make and ignores assumptions which can be made with greater confidence. The strategic approach to valuations segregates reliable and unreliable information, relies on strategic judgments about the current and future state of competition in the industry, does take into account the resources invested in the company. The strategic approach to valuation involves valuing a company at 3 levels: asset value, earnings power value, and total value. The strategic approach to valuation involves decomposing the value of a company in terms of 3 tranches: asset value, franchise value, and growth value. Whether growth is good or bad depends on how asset value compares with earning power value. Asset value is a value based on the assets of the firm. Earning power value is the value derived from the earning power of the firm. If asset value is greater than earning power value, growth is bad. If asset value is equal to earning power value, growth is neutral. If earning power value is greater than asset value and strategic analysis confirms that the firm enjoys sustainable competitive advantage, growth is good. The 3 tranches of value are shown in this diagram. drawn from a very insightful book titled Competition Demystified, written by Greenwald and Kahn of Columbia University. As we see in this diagram, there are three components of value: reproduction cost of assets, franchise value, value of growth. What do these mean? Reproduction cost of assets represent the value of the firm when there is no entry barrier in the industry to which the firm belongs and the firm does not have any competitive advantage whatsoever. Suppose a firm has an asset base which is reproduction cost of assets of 100 million and it earns return on invested capital of 10%. Its weighted average cost of capital is also 10%. The firm does not have any competitive advantage, so ROIC is equal to WACC. It doesn't earn any spread over WACC. In such a case, the value of the firm would be the asset value. What happens if the firm earns a spread over weighted average cost of capital? Let us say this firm earns a return on invested capital of 12%, which means it enjoys certain competitive advantages which add to its value, and the value arising from that competitive advantage is referred to as franchise value. The third component of value is value of growth. Suppose the firm can make additional investment of 100 million and still earn superior return on invested capital of 12%. When I say superior ROIC, I mean ROIC, which is greater than weighted average cost of capital. When the firm has that potential, there is a value of growth. So we find that there are three tranches of value: reproduction cost of assets, where there is no barrier to entry and firm has no competitive advantage, barely earns a return on invested capital which is equal to weighted average cost of capital. Franchise value is derived from current competitive advantage which enables the firm to earn a superior rate of return. Value of growth arises when growth benefits from competitive advantage and the firm can earn superior returns on additional investment as well. Asset value is reproduction cost of assets. Earning power value is reproduction cost of assets plus franchise value, and total value is the sum of the three tranches. Private equity and venture capital have assumed tremendous significance in recent decades. Private equity investors, referred to hereafter as PE, generally participate in the equity of investee companies that they hold for a few years before liquidating the same. The returns come mainly from liquidating their investments, as they expect negligible dividends during the holding period. The procedure used by the PE in valuing the assisted entity and structuring the deal typically involves the following steps. 1. The PE establishes a rate of return that it expects to realize from the investment KPE. This rate of return is commensurate with the risk and time horizon of the investment. 2. The PE's required rate of return is used to determine the rupee value the PE hopes to realize at the end of its planned holding period, H years, which is usually 4 to 7 years. PE investment today multiplied by 1 plus KPE raised to the power of H is equal to required value of PE investment at the end of the holding period H. 3. The P estimates the value of the firm's equity at the end of year H by applying a multiple to the firm's projected earnings before interest, taxes, depreciation and amortization for year H. Estimated equity value of the firm at the end of year H is EBITDA for year H multiplied by an EBITDA multiplier at the end of year H plus cash in the investee firms minus debt of the investee firm. 4. The P determines the ownership it requires to generate the desired rate of return. Ownership share is equal to required value of P investment at the end of year H divided by estimated equity value of the firm at the end of year H. The above procedure may be illustrated with an example. Omega Capital Ventures, a PE investor, is considering investing 1,000 million in the equity of Mylan Laboratories, a startup biotech company. Omega's required rate of return from this investment is 30% and its planned holding period is 5 years. Mylan has projected an EBITDA of 1,500 million for year 5. An EBITDA multiple of 7 for year 5 is considered reasonable. At the end of year 5, Mylan Laboratories is likely to have a debt of 1,000 million and a cash balance of 300 million. What ownership in Mylan Laboratories should Omega Capital Ventures ask for to get its target return of 30%? The required ownership share is determined as follows. 1. KPE, required rate of return, is 30%. 2. Required value of P investment at the end of year 5 would be 1,000 million, its investment multiplied by 1.30 raised to the power 5, which is 3,713 million. The estimated value of Mylan Laboratories at the end of year 5 is EBITDA for year 5 multiplied by a multiplier of 7 plus 300, which would be the cash balance, minus 1,000, which would be the debt. This works out to 9,800 million. The ownership share that the P investor would ask for is 3,713 divided by 9,800, which is 37.9%. If Omega Capital Ventures gets an ownership share of 37.9% in a firm which has these characteristics, it can hope to get a return of 30% over a 5-year period. While a private equity investor invests in companies which have a track record of revenues, venture capitalists typically invest in startups which do not have a track record of revenues. They plan to remain invested for 5 to 7 years and liquidate their investment after that period. Since they have very little data to work on, they follow a procedure which is relatively simple. One of the methods followed by venture capitalists is called the venture capital method of business valuation. In this method, the planning period is defined and the expected revenues of the investee company are estimated. These revenues are multiplied by a factor of 2 or 3 to get the exit value. In the case of a P investor, usually the target value of the firm is calculated by assigning a multiple to EBITDA, whereas in the case of a venture capitalist, the exit value is usually estimated by multiplying expected revenues by a multiple like 2. Based on this, the venture capitalist determines the kind of stake it should get in the investee company. Let us understand this procedure with the help of an example. Omega Venture Capital wants a targeted ROI of 8 on its investment. Here ROI has a very different meaning. Here ROI means that investment should multiply by a factor of 8. So when Omega Venture Capital says that its target ROI is 8, it means if it is investing 10 million rupees, it wants its investment of 10 million rupees to grow to 80 million. It is considering an investment of rupees 10 million. What stake should it get? The procedure for establishing the stake is shown here. Step 1, estimate the exit value. Exit value is here estimated as 2 times projected revenues of rupees 200 million in year 5. So exit value is rupees 400 million. Step 2, define the targeted ROI. Here the targeted ROI is 8. Usually the target ROI is 8, 10, 12, 15 depending on the riskiness of the venture and the target holding period. Step 3, calculate the post-money valuation. Post-money valuation is defined as exit value of the enterprise divided by targeted ROI. This enterprise is expected to have an exit value of 400 million, 200 million times 2, targeted ROI is 8. So post money valuation is rupees 50 million. This is the valuation imputed on the investing company today after infusion of funds has been made by the venture capitalist. So after the venture capitalist infuses rupees 10 million, the value of the investing company would be 50 million. That is why it is called post money valuation. Step 4, determine the stake the venture capitalist should get. Since the venture capitalist is investing rupees 10 million and the firm has been assigned a value of rupees 20 million after the investment, the stake the venture capitalist should get is 20%. If it gets a stake of 20% in a venture which is assigned a value of 50 million today after the investment, then it can hope to achieve an ROI or a multiple of 8 at the end of year 5 when the exit value of the firm would be rupees 400 million. There is another concept used in venture capital analysis which is called pre-money valuation. Pre-money valuation is simply post-money valuation minus the investment the venture capitalist would make. Since post-money valuation here is rupees 50 million and the proposed investment is rupees 10 million, pre-money valuation is rupees 40 million. This is a valuation assigned by the venture capitalist to the investee company before the venture capitalist gets into the project. Corporate valuation practice. Relative valuation is very commonly used. A variant of relative valuation is transaction multiples approach, where you look at the transaction that may have taken place of a similar kind. DCF valuation is also commonly used. This is what we find commonly. For IPO, relative valuation is the most important approach to valuation because you have to value a company relative to the values of similar companies in the market. You can't deviate too much from that. For mergers and acquisitions, DCF valuation seems to be the principal method along with transaction multiples, or a hybrid model wherein you use DCF valuation along with an estimate of terminal value based on some multiple. In mergers and acquisitions done by a financial buyer such as a private equity fund, DCF valuation is the primary method and the focus of this valuation is on internal rate of return. A financial buyer like a private equity fund defines a hurdle rate of return of say 20-25% depending on the risk that it perceives in the business. Here is an interesting practical example of valuation. This was the valuation done in the context of a merger of ICICI with ICICI Bank in 2001. The valuers were asked to determine a fair exchange ratio. ICICI employed JM Morgan Stanley as its financial advisor and ICICI Bank employed TSP Merrill Lynch as its financial advisor, and the two organizations employed Deloitte Haskins and Sells, an independent accounting firm, in connection with the proposed amalgamation. J.M. Morgan Stanley used three methods: historical market price analysis, dividend discount analysis, and precedent transaction analysis. Based on historical market analysis, they found an exchange ratio of 1 to 2.04 to be reasonable, which means one share of ICICI Bank to be given for 2.04 shares of ICICI. Based on dividend discount analysis, they found an exchange ratio of 1 to 1.83 to 2.11 reasonable. Based on precedent transaction analysis, they found an exchange ratio of 1 to 2 to be reasonable. DSP Merrill Lynch used three methods: historical market analysis, dividend discount analysis, and precedent transaction analysis. They found that an exchange ratio of 1 to 1.6 to 2 to be reasonable under this method, an exchange ratio of 1 to 1.8 to 2 to be reasonable under this method, and an exchange ratio of 1 to 1.82 to 2.1 reasonable under this method. Deloitte Haskins and Sells used three methods: historical market analysis, dividend discount analysis, and NAV analysis. Based on historical market analysis, they found an exchange ratio of 1 to 1.94 to be reasonable. Based on dividend discount analysis, they found an exchange ratio of 1 to 2.17 to be reasonable. Based on NAV analysis, they found that the reasonable exchange ratio of 1 to 0.06. This was clearly an outlier in relation to all other exchange ratios. They, however, discarded by saying that ICICI was very tangible asset intensive but had limited growth prospects. On the other hand, ICICI Bank was an intangible intensive organization with superior growth prospects, so NAV should not be considered as an appropriate basis. Finally, based on all the deliberations, an exchange ratio of 1 to 2 was established. There are several myths surrounding valuation. One, since valuation models are quantitative, valuation is objective. Valuation is a subjective, imprecise, and uncertain exercise. It is not objective, precise, and definite. 2. A good valuation provides a precise estimate of value. At best, a good valuation can provide a range of reasonable value. 3. A well-researched and well-done valuation is timeless. Valuation is done at a particular point of time. The value of a company changes over a period of time in response to changing financial parameters and market conditions. So, no valuation can be regarded as timeless. It is done at a specific point of time and it is subject to change over a period of time. 4. The market is generally wrong. More often than not, the market is in a reasonable range. Occasionally the market becomes very aberrant, but it is wrong to presume that market is generally wrong. 5. The product of valuation, the value is what matters. The process of valuation is not important. The product of valuation is important, but the process of valuation is equally important and sometimes even more important. The process of valuation throws a lot of light on underlying factors and provides a great deal of illumination. 6. Valuation is an art. Valuation is neither science nor art. It is an odd mixture of art and science, or you can say it is art informed by science. An E&Y survey on business valuation practices in India has revealed the following. The average cost of equity is generally considered to be 15%. The cost of equity is deemed to be lower for FMCG companies and higher for real estate and EPC companies. The usage of capital asset pricing model for estimating the cost of equity has increased significantly over time. DCF method is commonly used in combination with other methods such as peer company multiples or transaction multiples. In DCF analysis, the explicit forecast period of 5 years is popularly used for estimating the terminal value or continuing value. The Gordon perpetual growth model is often used. In the Gordon perpetual growth model, the long-term stable growth is assumed to be around 5%. Having discussed various methods of valuation, it is time to reflect on valuation. 1. Valuation is not an extension of accounting. As we have seen, accounting is backward looking and valuation is forward looking. A financial balance sheet looks like this. On the asset side, we have value of assets in place and we have value of growth assets. On the equity and liability side, we have market value of equity and market value of debt. Although the structure of a financial balance sheet looks similar to the structure of an accounting balance sheet, a financial balance sheet is constructed very differently. On the assets side, we have value of assets in place. In addition, we have value of growth assets. This is the value that you impute to the future growth of the firm. Such a figure is never found on an accounting balance sheet. On the equity and liability side, we look at market value of equity and market value of debt. In an accounting balance sheet, we look at book value of equity and book value of debt. So, a financial balance sheet is very different from an accounting balance sheet because finance is forward looking and accounting is backward looking. 2. Valuing an asset is often different from pricing the asset. We must distinguish between two processes, pricing process and value process. The price of a security depends on demand and supply, and demand and supply in turn depend on fundamental factors and sentimental factors. Often sentimental factors dominate fundamental factors in the short run. The pricing process is more relevant to a trader who has a short-term horizon. The trader is continually monitoring the market to determine the shifts in demand and supply to understand the changing mood in the market to take his or her decisions. The value process, as we have seen, is focused on establishing intrinsic value, which is a function of cash flows, growth rate, and risk exposure. Valuation is very important to a long-term investor who wants to know what is the intrinsic value of a security. By comparing the intrinsic value of a security with the prevailing market price, the investor can take a decision for long-term investment. If there is a serious discrepancy between the two, the investor would like to profit from that discrepancy. If we look at the practice of investment banking, we find that investment bankers typically use a two-step process for valuing and pricing IPOs. Step 1, the investment banker arrives at a rough idea of value based on fundamental analysis. Here he uses various tools and techniques of valuation that we have discussed. Step 2, the investment banker tests the market sentiment. This is very critical because in the end price is established more by an exchange of information between the underwriter and investors and less by fundamentals. This is interesting. While the first anchor of valuation is based on fundamental analysis, the final price is determined more by sentiment and less by fundamentals. Often promoters and their merchant bankers price IPOs aggressively. This is puzzling because many anchor investors justify their subscription at such prices. 3. Valuation is easy to define conceptually but difficult to measure practically. Conceptually, we know that the value of an asset is equal to the present value of free cash flows associated with the asset from here to eternity. Everybody agrees on this definition of value, but measuring value is difficult, particularly measuring the value of a company is difficult. Who can divine cash flows or free cash flows from here to eternity? Who can say with certitude what the discount rate should be from here to eternity? We make educated guesses. Nobody has an idea about what the true or intrinsic value is, but everyone makes an educated guess. In that sense, value is like God. Nobody has seen God, nobody has witnessed the presence of God, but everyone has a notion of God. I'm reminded of a story. A little girl was doodling something on a piece of paper. Her mother asked, "What are you doing, darling?" The girl said sweetly, "Mama, I'm drawing the picture of God." The mother said, "Nobody has seen God. Nobody knows how God looks like. How are you going to draw the picture of God?" The little girl replied sweetly, "Mama, once I complete my drawing, people will know how God looks like." Sometimes, as a valuer, I feel like that little girl doodling something on a piece of paper, imagining that my calculation will deliver a true estimate of intrinsic value. I know in my heart of heart that this is a very subjective, imprecise, uncertain exercise, but as a valuer, I have to make an educated guess. 4. Given the difficulty in valuation, it makes sense to use 2 or 3 different approaches to valuation. We have learnt about various approaches to valuation, and we know that every approach has its advantages and disadvantages. So it makes sense to use 2 or 3 different approaches so that we have a balanced view on valuation. 5. Options are often an important source of value, particularly for an intangible intensive company. The value of options depends primarily on 2 factors: environmental uncertainty and managerial flexibility. Higher the environmental uncertainty, other things being equal, higher the value of options. Higher the managerial flexibility, other things being equal, higher the value of options. We can look at a 2 by 2 grid like this. When the environmental uncertainty is low and manual flexibility to respond to uncertainty is low, options have a low value. At the other end of the spectrum, when environmental uncertainty is high and manual flexibility to respond to that uncertainty is high, options have a high value. In the other 2 cells, options have a medium value. 6. The malaise of reverse financial engineering subtly characterizes most valuation exercises. Often we have a prior notion of what the value is, and the valuation exercise may be directed in such a way that the prior notion is confirmed. As Thomas Liss of Kellogg Business School said, valuation is just an excuse. The moment it becomes clear that the CEO wants to do the deal, no matter what, his investment banker and advisors are best advised to tell the emperor that his clothes are beautiful. 7. Issues like non-marketability, control premium, and synergies lead to several levels of value. We can look at 4 levels of value. If 100 is the freely traded value, then 70 is the non-marketability minority value, 140 is the control value because a control premium of 40% may be paid on the freely traded value. The strategic value may be still higher, and it may be 160 because the strategic investor may pay an additional premium. 8. The story has to be supported with data. Any valuation exercise is based on a story about how the future will unfold, and a good valuation exercise is one where the story is supported with data. Valuation is a bridge between numbers and stories. A good valuation combines a story along with numbers. I come across people who are good at number crunching. I come across people who are good at storytelling. You have to be good at both storytelling and number crunching. If you want to be an investment banker, you have to combine these 2 skills, because an investment banker has to tell a convincing story based on quantitative analysis. 9. Given the imprecision in valuation, work with the value range. Since valuation is an imprecise, uncertain, subjective exercise, it makes sense to work with the value range. It is foolhardy to say that the value of a company is 1143.2 million. It makes more sense to say that the value perhaps lies in a range of 1100 million to 1200 million. Such a range is very well accepted in valuation exercises. There is a fine passage attributed to Aristotle. It is a mark of an educated mind to expect that amount of exactness which the nature of the particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician and to demand strict demonstration from an orator. According to Benjamin Graham, the work of a financial analyst falls somewhere in the middle between that of a mathematician and an orator. 10. The process of valuation is as important or even more important than the product thereof. The process of valuation illuminates a lot of aspects which add to clarity, understanding, and insight. 11. Valuation is an odd mixture of science and art. Valuation is neither art nor science, it is a mixture of art and science. More importantly, valuation is an art informed by science. 12. In valuation, temperament often trumps intelligence and sophistication. Valuation requires common sense, good judgment, and good temperament. These are far more important than superior intelligence and sophisticated techniques. 13. Luck plays a disproportionate role in whether you make money off your valuation. The outcome in any situation is a function of two factors: quality of process followed and luck. Even though you may follow a good process, you may not be lucky and the outcome may not be satisfactory. On the other hand, even though you follow a flawed process, luck may favor you and the outcome may be very, very positive. 10 Commandments of Valuation. 1. Understand how the methods compare. 2. Use at least two different methods. 3. Work with a value range. 4. Go behind the numbers. 5. Value flexibility. 6. Blend theory with judgment. 7. Avoid reverse financial engineering. 8. Beware of possible pitfalls. 9. Adjust for minority discount and control premia. 10. Debunk the myths surrounding valuation. Here are the three key takeaways. 1. Use at least 2 to 3 methods. 2. Beware of reverse financial engineering. 3. Work with a value range. As Gerald Loeb wrote in his famous book, The Battle of Investment Survival, there is no such thing as a final answer to security values. A dozen experts will arrive at 12 different conclusions. It often happens that a few moments later, each would alter his verdict if given a chance to reconsider because of changed income statements, much more by the hope and fears of humanity, by greed, ambition, acts of God, invention, financial stress and strain, weather, discovery, fashions, and numberless other causes impossible to be listed without omission. In a similar vein, Arthur Stone Dowing wrote, "Value is subjective, it is based on individual human experience. Hence, when the individual tries to find an objective standard or criterion for his own personal values, he is confronted with endless confusion. Value changes from hour to hour. Value is different according to the standards of judgment." Here is an interesting case of changing valuation over a period of time. In 1992, Yahoo had a chance to buy Google in its nascent stage for just $1.2 million, but Yahoo said Google's page rank ain't worth the pennies. In 2002, Yahoo had the might to buy Google for $5 billion, but they considered it overvalued. In 2008, Microsoft offered to acquire Yahoo for $45 billion, but Yahoo considered the offer inadequate. Finally, in 2016, Yahoo sold its core operating business to Verizon for $4.8 billion in cash. This transaction ended the independence of one of the most iconic pioneering companies in Silicon Valley, which was worth $125 billion in its heyday. Here are some conspicuous examples of divergence in values. I have seen Kisan food products being valued in a short span of time at 6 crores, 12 crores, and 24 crores. Kothari General Foods was on the verge of bankruptcy, so the lenders invited potential bidders to acquire controlling equity stake in the company. Jagatjeet Industries offered to buy out the stake of Kothari's for 1 rupee a share, and Brook Bond offered 7 rupees a share. Such a wide divergence is rather rare, but you do find such discrepancies in valuation. How Morgan Stanley valued Flipkart over a period of 15 to 16 months. In June 2015, it put a valuation of close to $15.5 billion. That valuation was gradually lowered, and in September 2016, it was put at $5.58 billion. This is how value tends to change over a period of time in response to variation in performance and, more important, changes in outlook and perception. As Milton Rock said, in the end, even when armed with results of various analyses such as DCF values, secondary market trading levels, a history of comparable transactions, and estimates of liquidation replacement values, the evaluator moves from the arena of seeming precision in science to the realm of judgment in art. Before we close, I want to emphasize one point. Whether you're valuing a young company or an old company, whether you're valuing a startup firm or an established firm, the principles of valuation remain the same. Somehow people have invented new paradigms, ignoring old principles, and committed a lot of errors. In the face of negative earnings, intangible assets, analysts have abandoned the rationale behind the old principles and embraced new ways for justifying investment in young firms. Internet companies were valued on the basis of number of visitors. The assumption was that number of visitors to the site would translate to revenues, which in turn will get translated into profit. All too often, many of these assumptions were untested, leading to unrealistic valuation. The cycle has been repeated with social media companies. The search for new paradigms is clearly misguided. The problem is not conceptual. The problem is one of estimation. Estimating the value of a young company or a startup firm is far more difficult than estimating the value of an old and established company. The principles, however, remain the same. We have covered a vast terrain. Let us sum up our discussion. Fair market value is the price at which property changes hands between a willing buyer and a willing seller, both parties having reasonable knowledge and relevant facts. This is the definition of fair market value provided by Internal Revenue Service in the US, and it is widely accepted globally by professional valuers. There are five broad approaches to business valuation: asset-based approach, DCF approach, relative valuation approach, option valuation approach, and strategic approach. Asset-based valuation relies on information in the balance sheet. It is often adjusted for replacement cost or liquidation value. DCF approach involves forecasting future cash flows and discounting them using the weighted average cost of capital of the firm. Relative valuation calls for valuing a company on the basis of how similar companies are valued in the marketplace. Option valuation approach is helpful in valuing companies which have valuable real options embedded in their operations. The strategic approach to valuation calls for decomposing the value of a company in terms of three tranches: asset value, franchise value, and growth value. Asset value is more easy to establish, franchise value is slightly more difficult to establish, and growth value is even more difficult to establish. DCF valuation and relative valuation are the most popular approaches to valuation. Valuing an asset is different from pricing an asset. Pricing involves a consideration of demand and supply, and pricing is often influenced by fundamental factors and sentimental factors. Perhaps the latter are more important. Valuation calls for estimating free cash flows, projecting growth trajectory, and assessing risk. Given the difficulty, in valuing a company, 2 or 3 different approaches should be employed. The malaise of reverse financial engineering characterizes most valuation exercises in practice. Valuation is a bridge between numbers and stories. I tell my students at IIM Bangalore that if they want to be successful investment bankers, they must be skillful in financial modeling as well as storytelling. Valuation calls for providing the bridge between numbers and stories. Valuation is an art informed by science. A classic work on valuation is by Aswath Damodaran. The title of the book is Damodaran on Valuation. Book Valuation, Measuring and Managing the Value of Companies, authored by McKinsey Consultants, is in 7th edition. It is regarded as the most authentic guide for professional valuation work. Thank you.